Hello and welcome. This is the Security System and Alarm Services Company Financial Model Overview. This model's been around for a while on um, my site and other vendors, but what I've done recently is added a three-statement model interconnection module as well as a cap table and updated some of the global controls and formatting. So what I'll do today is go through each tab. You'll see all the logic of how the model works and all the additional financial statements that were added. And I'll do this by tab. We'll go through each of the assumptions so you can understand how everything's connected. Note there's also an index page that gives a high-level overview of each tab. So first off, you start here on the Global Control tab. You can put in the company name. This will go to the income statement, balance sheet, cash flow statement at the top. Launch year. This will define all of your drop downs, what the start month is, in dates that you have selected in the forecast. Note if you change this, you need to change drop downs. For example, this revenue here, we'll say January or June 2022, but it has from year 2022 to 2026. If you were to update this to say 2023, you would need to go through and adjust that accordingly, as well as all of the other dates in all the drop downs and all the different tabs, which there's a couple here. Everything is editable. All the tabs are in yellow. Now you can edit these other tabs, but they're formulas. They're not meant to be, but if you want to modify it, you can. But the main input tabs are yellow. Next, you can enter the end month exit. This is just to define when the template should stop. If you're just doing a regular 5-year template, you could just stop it in the last month. Or if you're doing a different time period, you can just adjust that there. You can also determine if you want to include the terminal value or not, which is going to be good for discounted cash flow analysis to get your enterprise value or terminal value. If you don't want to show that in the cash flow or anything, you could just hit no, and then the template will just run until your end month here, and then it will stop, but there will be no exit value. If you do include this terminal value, hit yes, and put the multiple. It's going to take your trailing 12-month revenue and multiply it by whatever you have here, and that's going to be the value. And then that will show up accordingly. Next, you have cash sources. So this is just a regular debt schedule. If you put in 250,000 here, you can see your debt schedule is going to start with 250. You can put the terms on it for that there, and then you'll see a amortization schedule that flows through the model. Note if you adjust the global control to include the terminal value, then on whatever end month there is, the total remaining debt will be paid off. If you hit no here, you can see I hit no, it'll just go on into perpetuity, and you can see there it just goes through the whole schedule, and that'll just show up on the 5-year monthly and annual forecasts accordingly based on principal, interest, and balance. Next up, so this is just some investor and owner data. This will all come from the cap table, but essentially you see how much money you need in total. The model solves for this based on startup costs and any burn, and then you can define who is going to come up with that money and how much of the company you're giving away accordingly. Also, debt and equity breakdown based on all this, and then we've got taxes. If you want to show taxes, you can. If not, you can zero it out. This just takes the model does solve for taxable income and then applies that rate to the year based on the annual net income. If it's negative, there would be no tax. If we go to revenue, this is where actually all the magic happens for the assumptions. This is where you'll spend probably most of your time if you're building this forecast out. And so you start here by figuring out the start month of revenue. It might be the first month of the year of the forecast. It could be some month after that. You can define it there, and then you could define how many locations you're adding per month in each year. So in this case, we start with 0, and then we add 30 per month in year 1, 35 per month in year 2, etc. And then you could define up to 3 tiers. So you could have locations, and those tiers are broken down into a bunch of different metrics. For example, low, mid, and high determines locations that you charge $28 a month for, 45, 85. Also, they can have different churn rates for each location type, the percentage of new locations added, by location type is defined there. You can also adjust the margin on installations for each type, the actual cost of equipment, the amount of techs you need, average hours by each type. That will affect the cost of goods sold, the installation labor. You've also got margin on the install. If you go down here, this revenue is based on the margin, which is essentially taking your total labor and equipment costs, saying what margin you want to make on it, and then that's going to show you your price you're going to charge for the initial installation for each type. You've also got upsells and downsells from tier 1 to upsold to tier 2, tier 2 upsold to tier 3, and tier 3 downgraded to tier 2 downgraded 1. And based on these percentages, you might have some negative churn, meaning that your existing customers' upgrades and improvement in how much they're paying outweighs the amount of lost revenue from customers that leave. So that can drive those metrics. You've also got service calls per year. So this is another revenue source. You can charge, you can define average service calls per location per year, the amount you charge per call, and the average hours per service call, which is going to go back into the hourly rates of the techs. And then let me clarify. So size and margin of installation. This is related to if I go over to cost, no, this is the margin on the monitoring service. So if you charge this is showing you what your monthly cost of goods sold is for your vendor. So in a security system, usually, and it doesn't have to be this way, but I just did this logic in case it is. Usually you're going to pay a monitoring service, and then you're going to provide this monitoring service to your customers, and you're going to make some markup on that, which is what this logic is for. Now this size and margin of installations here is saying of the total installations, how many are low budget, how many are mid-level, how many are high budget installs of the total installations that happen. So if you go over to this monthly detail, you can see this is all recurring revenue logic. You can see this logic right here is based on, you can see row 21, 22, and 23 of the revenue tab. And it's multiplying the total locations added across all tiers multiplied by either, depending on the year, and the one is either 21, 22, or 23. So that means the installs are not specific to the location tier. If they are, then you could just copy these percentages up here, make them the same for this. If all these, but it could be that this location tier has margins on the installation that are higher or lower, and etc. Or sorry, this defines, so you could have X, Y, and Z low, mid, and high locations added, and the margin earned, you can define of these total locations, like these 30 locations, how much of them fall into a low this margin, how many fall into this margin, how many fall into this margin, and you define the how many based on these percentages. So very granular here, but effective in getting proper forecasts. Like I said, this is probably where you're going to spend most of your time. Also here, again, we went cost of goods sold on the monitoring service. This is a recurring fee for the company, and this is what it is per location per month. Then you've got fixed costs. So here you can define like you got CEOs, general managers, office admin, customer service. You can define the start month of each, their monthly cost, and then the percentage change over time. Same with sales and marketing. And then same with other costs, you could define income tax. This is actually no longer relevant with the new logic that exists. Taxes are not defined differently. You got other costs per percentage of recurring revenue, so this is kind of a catch-all, and then other costs per location per month as a catch-all G&A. Service hour labor hourly cost for service calls, so this is separate on service calls. This is the labor rate against this is what you charge on the call. So you're going to make sure the hours and all that makes sense economically. Percentage of revenue paid with credit cards and the credit card fees. So if you collect money from customers with a credit card, you get to find that logic there. Startup costs are pretty straightforward. This is going to be just legal fees, any general costs that you have that are outside of inventory purchases or costs that exist elsewhere, and that'll be defined here. You can also put a reserve in. Cap table is where you actually define ownership structures. You've got total shares. You can do 3 types of shares. You can do investments with outside investors, how much they invested, what percentage of stock they have of each type, what's their total fully diluted ownership value. You can also see that for founders, operators, employees. They may or may not have invested, and then they'll get some percentage as well. And then you've got distributions summaries here, a 5-year summary based on the annual distributions and contributions up front. You've got IRR for each individual as well as in the aggregate. And then these are checks to make sure you haven't put in numbers that are not logical, meaning you've assigned more than 100% of the shares or something like that. Oh, and note, Global Control has sanity checks to make sure all of the different statements and summaries and everything are zeroed out, and that means there's no logical errors in what the data is saying to you. Let's see, CapEx. CapEx, here you might have vehicles. That's probably going to be the main depreciation item. You might have bought a building. If so, you can account for the building here. And then any vehicles and other equipment, computers, they're going to depreciating over time here, the month of purchase, useful life, the cost basis, and the item name. That all flows through all the financial statements. Inventory, this is going to determine how frequent you buy inventory. So every 3 months or 2 months or 6, you just put a number in there, and that's going to affect your cash flow, especially in the first 12 to 24 months. And in the purchase amount is going to be based on your expected future sales, and the resulting cost of goods sold will fill in based on, and that's based on this markup on equipment. So this is your equipment cost. This will go against the total locations that were added, and that will affect your cost of goods sold when you have those locations installed. But the actual purchase of that equipment could happen in earlier months. So that's what this logic does is it'll subtract it out in the income statement, but then add it back in the cash flow statement. So you can see in the cash flow statement here, you've got inventory purchases happening, and you can see we're only counting revenue, other OPEX, which doesn't include cost of goods sold, interest, taxes. So that's where you reconcile the cash amount against what your actual income statement net income is, because this has the equipment happening in the month, essentially the month that it's sold here. So that's how the because this is essentially a non-cash item, but for the purpose of stating income, you would state the cost of goods sold when you've earned the revenue for that item. Okay, so this inventory, debt schedule, we already went over. It's just an amortization schedule. Terminal value, this is just for the exit. If you do include an exit, you can define the percentage of those proceeds that go to fixed assets versus just extraordinary income. So if you put 100% here, it's just all going to go to extraordinary income and be taxed at your regular tax rate. If you put like 50% here, then it means half of the sale is going to go towards your fixed assets, and then based on whatever depreciation was done and what the current book value is, it'll do some tax amount based on that. And you can adjust those here, and you can see these bottom 3 are your this is the breakdown of how the exit proceeds are applied to extraordinary income versus CapEx, and here's the sale of the building, and altogether that'd be your total essentially exit proceeds, all three of those. Finally, we've got our financial statement. So this is income statement, all based on all those assumptions you adjust. This will show revenue. You can see cost of goods sold, gross profit margin, operating expenses I put into high-level categories. You can see more details on the monthly detail for those. G&A, other OPEX, startup costs. We've got EBITDA, interest, depreciation. Then you've got some things for taxes, and then finally net income. And you can see on the exit how these numbers affect the net income as well. Income statement annual is the same thing, but on an annual basis. Balance sheet monthly is showing cash and inventory over time based on all that logic I just went over. You've also got non-current assets. These are all the fixed assets over time, accumulated depreciation, total assets. Then we know assets equal liabilities plus owner's equity. So we've got liabilities is just long-term debt based on amortization is the only thing. And then equity would be funds contributed, and then the other part of equity would be retained earnings. And if you add up the liabilities and equity, you should equal the total assets, which you can see we do here. And here's the check. And if you want to discover exactly how that formula works, you could just look when you get the template. You can look at the formulas and see exactly what's going on. There's pretty cool stuff. Here, this is saying inventory balance is always 0 because the end year is even on this purchase. So 36912. Let's say I put this to 5, then we're a little bit offset. So you can see now you've got an ending balance on a couple of the years. And you can see every 5 months means the inventory pops up here, then you sell some of it in June, some of it July, some August, some September. You run out here, so you buy more, and then so that's kind of nice. It's all dynamic. So that's balance sheet, cash flow statements. Again, I went over the operating activities. You've also got investing activities, financing activities, and this all flows over to the balance sheet cash position right here. So that's all, the entire cash flow statement is just flowing right to the cash balance, and that's it. And that all balances out. It goes into the, again, the accounting equation. You can see on the exit, here's where the exit value happens. So a lot of cool stuff here. Formal financial statements are something, that's one of the main things I've added, and I think it's really useful to have. It just, the value of this is in the thousands, but I'm only charging, I think, $125 for this template. So super valuable. If I go to distributions, this is just a discounted cash flow analysis for the project as a whole. And then as the investor side and owner side, you can plug in a discount rate and get their IR or net present value. Here's the IRR. And note, this is also the same as the cap table. So 6.1 to 27.1 is the same as the aggregate cap table IRRs because it's the same data, just shown differently. Executive summary gives you the high level. So you've got subscription revenues, installation revenue, service call, you got your cost of goods sold, all your different expenses, EBITDA, other cash flow items. This kind of is a full, like, combining different statements into one view. So you can see it, and it's checked against the cash balance to make sure it matches. You've got some metrics, return metrics here to see as well for project and investor owners. Lots of cool visuals, revenues, MRR, expense summaries, cumulative locations over time, annual cash flow, cash distributions, locations added per month over time, monthly change in MRR, installations per month by type, installers needed by installer type, installation revenue per month by type, MRR expansion, so this is your upsells, monthly churn, this is lost and downgraded MRR, and then you can see expansion MRR versus churn. So if the expansion is higher than the churn, you actually have a negative churn, which you can see the actual net result of that would be here, a real monthly churn rate. And negative is really good. That means you're making more from existing than you're losing from those that cancel. You got net MRR expansion, customer acquisition cost. Remember, this is recurring revenue business, so once to pay back that customer acquisition cost is really important. Lifetime value of a customer to CAC is also very important. Average customer lifetime value, and then again, customer acquisition cost. So very good metrics here to watch. Monthly details where you can see the actual granular level of all the different tiers, the dollar value of all the upgrades or upsells, downsells, and the final monthly recurring revenue for each tier and in total, as well as installation revenue, service calls, cost of goods sold, equipment purchases, other cost of goods sold, gross profit, installation labor costs, your fixed costs, EBITDA, debt service, startup costs, all the different cash flow items, cash flow in total. Then here's some of your advanced metrics that go into the charts. Annual detail has the same thing, but on an annual basis. And after that, you're fully wrapped up. The template is completed, the overview. And hopefully you guys, if you're running or starting a security business, security system, alarm service business, this is a great template to have. Um, I mean, you don't need to, it's not like, uh, it's a great planner. It's a great thing to check your current numbers, see how your pricing is, see if you want to change something, what the effect might be. If you want to get the template, again, it's a $125 one-time fee. You can go through the link in the description box below. It's going to be listed at smarthelping.com, eFinancials, and Eloquence. All right, guys, take it easy. I'll see you on the next one.